Hello, everyone, and welcome back. Today, we're going to talk about your mortgage. It's a topic that keeps people up at night, staring at the ceiling at 3 a.m., wondering if the house of cards they've built is about to collapse. We talk a lot about interest rates, don't we? We obsess over what the central bank is doing. We watch the news, waiting for that decimal point to move up or down. But today, I want to suggest something controversial. The interest rate is not the most important number in your life. There is a number much more critical, much more personal, and that is the measure of your own leverage. Today, we're going to do a deep dive into overlending. I'm not talking about what the bank says you can afford. Banks have their own algorithms, their own risk appetites, and frankly, their goal is to sell you a product. Just because a bank approves you for $1 million loan does not mean you can actually afford $1 million loan. So how do you know? How do you know if you've crossed the line from healthy leverage into the danger zone? Based on some fantastic insights I've been reviewing, combined with what we see in the broader market, I've broken this down into 3 definitive standards. These are your litmus tests. By the end of this episode, I want you to look at your finances and answer one simple question. Am I safe? Let's get into it. Standard 1. The cash flow reality check, the water bucket theory. The first standard is the most immediate. It's your cash flow. I want you to visualize a simple analogy. Think of your household finances as a water bucket. Your income, that's the water tap, the faucet pouring into the top. Your expenses are the holes in the bottom. Now debt? Debt is a massive hole drilled right into the side of that bucket. If the water coming in and your income isn't strong enough, or if the leak, your debt repayment, is too fast, that bucket is going to run dry. It sounds simple, but you would be shocked at how many high-income earners ignore this physics until the bucket is empty. So, let's look at the numbers. What constitutes overlending in terms of monthly cash flow? The danger zone. 50% to 60%, the most direct indicator of financial stress, is the percentage of your monthly income that goes solely to servicing debt, specifically your mortgage. In the industry, we often say that if your mortgage repayment eats up 30% to 40% of your net after-tax income, you are already in a tight position. You're feeling the pinch. You have to budget carefully. But once that number creeps up to 50% or 60%, you're walking on a tightrope without a safety net. This is a massive red flag. Let's put real numbers on this to make it stick. Imagine a household bringing in 10,000 Australian dollars a month after tax. That sounds like a healthy middle-class income, right? But if this family went out and bought a dream home at the top of their borrowing capacity and their monthly repayment is $6,000, they are in trouble. Think about the math. They have $4,000 left. That sounds like a lot until you factor in groceries, utilities, car insurance, petrol, school fees, internet, and phone bills. Suddenly, that $4,000 evaporates. The compressed life syndrome, when you are at this 60% level, you enter what I call the compressed life. This is where your loan essentially locks down your lifestyle. You aren't just paying a bill, you're sacrificing your quality of life. The extras vanish first. No more family vacations. No more dining out. But then, the essentials start to get squeezed. Maybe you delay fixing the car. Maybe you put off a dental appointment. This creates a state of perpetual anxiety. You're essentially working just to keep the roof over your head, but you can't enjoy living under that roof because you're too stressed about paying for it. So, the first test is simple. Do you have to grit your teeth to make the payment every month? If paying your mortgage feels like a physical or emotional struggle, you have borrowed too much. It doesn't matter what the bank says. Your gut is telling you the truth. Standard 2. The stress test, the missing safety cushion. Now, let's move to the second standard. This is where most people fail because human beings are naturally optimistic. We tend to assume that tomorrow will be exactly like today. We assume our income will stay the same or go up and that interest rates will stay flat. But history and economics tells us that stability is the exception, not the rule. The second standard of overlending is, do you lack a sufficient risk buffer? You need to act like your own bank's stress tester. You need to ask yourself 2 very specific, very uncomfortable questions. Question A. The interest rate spike, if interest rates rose by 1% or 2% tomorrow, could you still put food on the table? We saw this happen globally recently. People borrowed when rates were at historic lows, essentially free money. Then, rates normalized. For a large mortgage, a 2% jump isn't just a few dollars. We're talking about monthly repayments jumping by hundreds, maybe even thousands of dollars. If a 2% rise means you go into default, you are overleveraged. You're operating with zero margin for error. Question B. The income drop. If your household income dropped by 20% to 30%, could you survive? This isn't just about losing a job. It could be a reduction in overtime hours. It could be a partner taking maternity leave. It could be a small business seeing a slow quarter. If your financial survival depends on your income being at 100% capacity 100% of the time, you are in a fragile position. The Moonlight Clan trap. This leads us to the concept of savings. I'm not talking about investment savings. I'm talking about keep the lights on money. In many Asian cultures, there's a term called the Moonlight Clan, people who spend their entire paycheck by the end of the month. If you're paying off a massive mortgage and, as a result, you have zero savings at the end of the month, you have become a mortgage Moonlight Clan. The standard rule of thumb is you need 3 to 6 months of living expenses in liquid cash. This is your sleep well at night fund. If you have a massive house but $0 in the bank, you're technically insolvent. You just don't know it yet. All it takes is one trigger event, one layoff, one medical emergency, and you're forced to sell the house. And usually, when you're forced to sell, it's a fire sale. You lose your equity, you lose your home, and you lose your credit rating. So, standard 2. Do you have a safety cushion? Or are you one bad phone call away from disaster? Standard 3. The future cage, opportunity cost. This brings us to the third standard. And personally, I think this is the most profound one. This isn't about math. This is about freedom. Standard 3 is, does your debt support your future goals, or does it suffocate them? We often forget that debt is a tool. It's a lever. It allows you to buy assets you couldn't otherwise afford. But there's a tipping point where the tool becomes a shackle. The golden handcuffs. I want you to look at your life plan for the next 3 to 5 years. Do you want to have children? Do you want to start a business? Do you want to switch careers to something you're more passionate about? Do you want to travel? If you look at your mortgage and realize, I can't have a baby because we can't afford for one of us to stop working, or I hate my boss, but I can't quit because I need this exact salary to pay the loan, then you are overleveraged. The loss of agility. This is what I call life agility. High debt removes your agility. Let's say you are an entrepreneur at heart. You see a gap in the market. You want to launch a startup. But a startup means variable income for the first 2 years. If your mortgage is $6,000 a month, you cannot take that risk. The debt has decided your career path for you. Or perhaps you want to upgrade your home in a few years. If you're maxed out now and the market dips, you might find yourself in negative equity, where the loan is bigger than the house value. You're stuck. You can't move. Investment versus speculation. This also applies to investment properties. Many people borrow to invest, thinking leverage is the key to wealth. And it is until the market turns. If you're highly leveraged in investment properties and the market dips, you might be forced to sell at the bottom to cover cash flow issues. That is the definition of buying high and selling low. That's not investing. That's gambling with money you don't have. So, the question is your loan a bridge to your future, or is it a wall? If your debt limits your human potential, if it stops you from living the life you actually want to live, then it has ceased to be a financial tool and has become a burden. The psychological toll, the invisible standard. I want to add a layer here that wasn't explicitly in the numbers, but is deeply tied to the text we are discussing today. That is the psychological toll of overleverage. There's a biological cost to financial stress. When you're living on that 60% debt-to-income ratio, your body is in a constant state of fight or flight. Cortisol levels spike. Relationships suffer. I've seen marriages fall apart, not because of a lack of love, but because of the crushing pressure of a mortgage that was too big. The anxiety of what if eats away at the foundation of the family. The text mentions that if you feel tight or anxious, you are on the edge. Listen to that feeling. Your body is a financial advisor too. If you feel a knot in your stomach every time you open your banking app, that is a data point you shouldn't ignore. So what now? Okay, we've gone through the 3 standards. Cash flow. Is the monthly payment dominating your income? For example, more than 50%? Risk buffer. Can you survive a rate hike or job loss without selling? Future goals. Does the debt prevent you from making life changes? If you're listening to this and nodding your head, thinking, oh no, that's me. I'm a 60% guy. I'm the Moonlight Clan. Do not panic. Panic leads to bad decisions. Here is what you can do. 1. Acknowledge and audit. The first step is honesty. Stop hiding the bills. Sit down, look at the numbers, and accept the reality. You cannot fix what you do not measure. 2. Aggressive deleveraging. If you have no buffer, your number 1 priority is building that safety net. This might mean pausing all discretionary spending. It might mean picking up a side hustle for 6 months. It might mean selling the second car. You need to stop the bleeding and build a wall of cash around you. 3. The hard choice. Downsizing if the math simply doesn't work. If you are at 70% debt to income and there's no raise coming, you have to consider the nuclear option, selling the asset. There is no shame in downsizing. It is better to sell a house on your own terms and move to something affordable than to have the bank foreclose on you 2 years later. Regaining your peace of mind and your cash flow is worth more than the square footage of your house. Conclusion. To wrap up today's episode, I want you to remember this. Financial success is not about owning the most expensive things. It's about having the most options. Liquidity is freedom. A manageable mortgage is freedom. A buffer in the bank is freedom. Don't let the societal pressure to own big push you into a corner where you spend the next 30 years anxious and paralyzed. Use these 3 standards. Check your bucket for leaks. Stress test your safety net. And ensure your debt is building your future, not stealing it. If you can answer these questions with confidence, congratulations, your loan is a tool, and you're the master of it. If not, it's time to make a change before the market makes it for you. Thank you for listening. If you found this helpful, share it with someone who might be house hunting right now. You might just save them from a 30-year mistake. See you next time.